We all know cars lose value over time, right? That's just appreciation. But what happens after an accident? Your car gets fixed, looks perfect, but somehow it's still worth less.
Yeah, a lot less sometimes. And that hidden hit, that's what we call diminished value.
Right. So today, we're really digging into that. Diminished value. What is it exactly? When can you claim it? And maybe most importantly, how do you avoid the pitfalls?
Absolutely. And, a key thing we'll unpack is how this value is often calculated. Because the methods insurers use, they can be, well, let's just say they don't always work in your favor.
Okay, so our mission today is pretty clear. Cut through the confusion. We want to give you the facts, show you the common traps, and really empower you so you know your rights and options. Turn that frustrating feeling into an aha moment.
Exactly. And we've looked at a bunch of sources for this, insights from expert appraisers, legal takes, what the insurance industry itself says, and even real stories from people online.
So let's start right at the top. What exactly is diminished value? Lay it out for us.
Okay, so diminished value, or DV. It's basically the drop in your property's market value after it's been damaged and then, repaired. We mostly talk about cars, but it can apply to other things too, like, say, real estate collectibles.
But the key is, it's after the repairs are done, even if they're perfect.
Precisely. Even with flawless repairs, the value is still lower than an identical car that wasn't wrecked.
Okay, why? Why does that happen? If it looks the same, what's the issue?
Well, think like a buyer. You're looking at two identical used cars. One has a clean history, the other was in a significant accident but repaired. Are you paying the same price for both?
Probably not. I definitely prefer the one with no accident history.
Right. There's always that doubt, isn't there? Like, are the replacement parts as good as the original? Could there be some hidden damage, something structural that might show up later?
Yeah, that makes sense.
Yeah.
You just don't know for sure.
And then you've got companies like Carfax, AutoCheck. Their whole business model is built on highlighting accident history. They've kind of conditioned us all to be wary of cars that have been in a wreck. It's just a market reality now.
Got it. So how is this different from just normal depreciation? Because, all cars lose value.
That's a really important distinction. DV is not the same as depreciation. Depreciation is, well, expected. It's predictable loss over time, wear and tear, age. Diminished value is sudden, it's unexpected, it's tied directly to that specific event, the accident. You can't claim for normal depreciation.
Okay, clear distinction. Are there different kinds of diminished value?
Yes, there are generally three main types people talk about. First, there's inherent diminished value. This is the most common one. It's the automatic loss in value just because the vehicle has an accident history now, even if the repairs are perfect. Almost every car in a significant accident has this.
Okay, inherent DV. What else?
Then there's repair-related diminished value. This happens when the repairs themselves are shoddy or substandard. Think mismatched paint, maybe parts that don't quite fit right, poor workmanship, that directly lowers the value because of the bad repair.
Right, bad repairs make it worth less. That seems obvious.
It does. And finally, there's immediate diminished value. That's the loss in value right after the accident happens, before any repairs are even started. It's the difference between the pre-accident value and the value of the damaged, unrepaired vehicle.
Okay, inherent, repair-related, and immediate. Let's maybe use an example to make inherent DV really concrete.
Sure. Let's say you have a used car. Market value is about $20,000. You get into an accident, not your fault. It's repaired perfectly, looks great.
Okay.
But now, when you go to sell it, a buyer checks the vehicle history report, sees the accident. They were willing to pay $20,000, but now they only offer, say, $18,000.
So that $2,000 difference, that's the inherent diminished value.
Exactly. That's the financial hit you've taken purely because of the accident history, even with perfect repairs. It's real money.
It absolutely is. So if you're listening and thinking, okay, I think my car lost value, how do you actually go about making a claim? Because like you said, insurance companies aren't exactly shouting this from the rooftops.
No, they generally aren't. The usual way this works is you file what's called a third-party diminished value claim. That means you file it with the insurance company of the driver who was at fault for the accident.
So against the other guy's insurance.
Typically, yes. Most insurance policies won't let you claim diminished value against your own policy if you caused the accident. That's called a first-party claim, and it's usually excluded.
Usually.
Yeah.
But I've heard sometimes it depends on the state. Are there exceptions?
Absolutely. And this is where it gets kind of tricky and state-specific. Some states actually do allow first-party claims in certain situations. Georgia is a really interesting example.
Ooh. What's different about Georgia?
In Georgia, you can pursue a claim against your own insurance, even if you were at fault. And what's more, insurers there are actually required by law to proactively offer diminished value compensation to their own policyholders. It's quite unique.
Wow, okay. That's a huge difference. Proactively offer it.
It is, and beyond that, some states might also let you claim against your own policy under the uninsured or underinsured motorist property damage coverage. If the at-fault driver has no insurance or not enough, or maybe it was a hit and run.
So definitely need to check your specific state laws.
Crucial. And it's worth knowing, pretty much all U.S. states and territories allow third-party claims claiming against the at-fault driver's insurance. The only exception, the only place you generally can't, is Nebraska.
Okay, good to know. What about timing? Say the accident happened, I don't know, a year or two ago. Is it too late?
Well, it's always better to file sooner rather than later. It just makes documenting everything easier, and the market value assessment is more accurate closer to the event. Cars lose value over time anyway, right? But the good news is most states have what's called a statute of limitations, and it's often several years. We mentioned Georgia there. It's 4 years for property damage claims, which includes diminished value.
4 years. Okay, so definitely don't just assume it's too late.
Exactly. Check your state's specific time limit. You might still be well within the window.
And does every car qualify? Or maybe, does every claim result in a big payout? Are there certain criteria that make a claim stronger?
Yeah, not every situation will lead to a huge DV payout, but many do qualify for something. Insurers often look for certain things. Again, this can vary, but typical factors making a claim stronger include the car having a significant market value to begin with, say, over $7,000.
Okay, higher value cars are more likely candidates.
Generally, yes. Also, having more than maybe $500 in actual property damage repairs, having relatively low mileage for its age, having a clean title before the accident, and often being less than, say, 10 years old.
Those sound like reasonable benchmarks. But what if your car doesn't tick all those boxes? Like maybe it's a bit older or the damage wasn't massive.
That's a really important point. Even if your vehicle doesn't perfectly fit that ideal profile, it is often still worth filing a claim if you're within the statute of limitations. The insurance company might still be legally required to pay something for the diminished value, even if it's not thousands of dollars. Don't just give up because it's not a new, expensive car.
Okay, that's encouraging. So let's say someone's listening. They think they have a case. What is the absolute first thing they should do? Like step one.
Step one, honestly, is educate yourself. Know your rights in your state, because like we said, insurers generally won't bring it up unless you, the claimant, specifically ask about diminished value.
Knowledge is power, basically.
It really is here.
Right.
Okay, so once you're informed, the practical steps usually look like this. First, notify both your insurance company and the at-fault driver's insurance company that you intend to pursue a diminished value claim. Do this early on.
Get it on their radar immediately.
Yes. Second, and this is critical, get a professional, independent vehicle appraisal specifically for diminished value. This is your key piece of evidence.
An independent one, not just one the insurance company suggests.
Ideally, yes, an independent one working for you. We'll talk more about why later. Third, gather all your supporting documents. That means the accident report, police report if there was one, all your repair bills, estimates, photos before and after.
Pre-accident value estimates, too.
If you have them, definitely. Anything that establishes the car's condition and value before the crash. Fourth, submit a formal demand letter to the insurance company.
Okay, a formal letter.
Yes. Clearly state the amount of diminished value you're claiming based on your appraisal and attach copies of all your evidence. And fifth, be ready to negotiate.
Ah, the negotiation part. Sounds potentially tricky.
It often is. Insurance companies frequently start with a very low offer, or sometimes even deny the claim initially. You need to be persistent and firm, using your appraisal and evidence.
That sounds like a process where things could easily go wrong.
Yeah.
What are the biggest mistakes people make that cost them money here?
Oh, there are definitely common mistakes. The biggest one probably is simply not knowing diminished value is even a thing. If you don't know you can claim it, you get zero. Simple as that. Many people just aren't aware.
Just lack of awareness.
Okay.
What else?
Second, like we touched on, is believing it's too late. People hear statute of limitations and assume it's maybe 1 year, or they just give up after a few months. But it's often several years, so always check. Don't leave money on the table assuming you're out of time.
Check the deadline. Got it.
Third, is not knowing how to negotiate effectively.
Yeah.
Just taking that first lowball offer is a huge mistake. You need to be prepared to push back, provide your evidence, maybe write a rebuttal letter explaining why their offer is too low based on your appraisal.
So don't just roll over.
Definitely not. Which leads to the fourth mistake. Being afraid to actually demand what you're owed. Some people worry about causing trouble or maybe messing up their repair claim. But insurance companies are businesses. They often won't offer the full fair amount unless you formally ask for it and back it up. That demand letter is important.
Makes sense. You have to advocate for yourself. What about dealing with the insurance adjuster?
Right. The fifth big mistake is assuming the insurance company, even the at-fault parties company, is completely on your side. Their adjusters are trained to minimize payouts. That's their job, really.
Yeah.
They might use delay tactics, hoping you'll get frustrated and accept less.
So you need to be persistent.
Absolutely. Stay proactive, follow up regularly. If they say they'll get back to you in a week, maybe check in after, say, 2 or 3 days if you haven't heard anything, especially if you're waiting on an offer. Don't just wait passively.
Okay, good advice. Any other pitfalls?
Yeah, a few others. Simple documentation errors like sending incomplete information or disorganized files. Procedural mistakes like missing a deadline or filing with the wrong insurance company initially. And even communication errors, maybe discussing too much detail on social media or giving inconsistent statements to the adjuster. All these can hurt your claim.
Wow, okay. Lots to keep in mind. Now, you mentioned negotiation and lowball offers. Let's talk about how insurance companies actually calculate diminished value. I hear there's this formula, 17C.
Ah, yes, the infamous Formula 17 seam. It's probably the most common method used by insurers across the U.S. to calculate diminished value, or at least some variation of it.
You say infamous. Why?
Well, because it's widely criticized by independent appraisers and consumer advocates as being, frankly, flawed and often designed to undervalue your claim significantly.
Okay, tell us about where did it even come from?
It actually originated from a specific court case in Georgia back in 2001, State Farm versus Mabry. It was a massive class action lawsuit, something like 25,000 claims involved.
25,000. Wow.
Yeah, huge. And because assessing each claim individually was just logistically impossible, the court temporarily approved this formula, 17C, as a kind of simple one-size-fits-all method just to process that specific backlog of cases. It wasn't really intended as a universal standard for all future claims.
So it's like a quick fix for a very specific, massive problem.
Essentially, yes. A workaround. But somehow it got adopted much more widely by the industry afterwards.
Okay, so how does this work around? I mean, formula
Yeah.
actually calculate the value. Without getting lost in the math, what are the basic steps?
Right. It usually goes something like this. Step 1, they figure out your car's pre-accident value. They often use resources like the NADA Guides National Automobile Dealers Association.
Okay, find the starting value.
Step 2, they apply a base loss cap. And this is a big point of contention. It's typically capped at just 10% of that pre-accident NADA value.
Only 10% max. That seems arbitrary.
It is widely considered arbitrary. So on a $30,000 car, the starting point for diminished value is immediately capped at $3,000, no matter how bad the damage was.
Okay, what's next?
Step 3, they apply a damage multiplier. This is a decimal number, usually between 0.0000 and 1.00, based on the damage severity. So 1.00 might be for severe structural damage, maybe 0.50 for moderate damage, and 0.00 for cosmetic stuff only. They multiply that initial capped amount by this factor.
So they reduce it further based on damage severity.
Exactly. And then step 4, they hit it again with a mileage multiplier. This also reduces the value based on your odometer reading. Higher mileage means a lower multiplier, often dropping to 0 for cars over, say, 100,000 miles.
So high mileage can wipe out the claim entirely, according to this formula.
Under 17C, yes, often it can. So you take the NAD value, cap it at 10%, multiply by a damage factor, multiply by a mileage factor, and that's your diminished value offer.
Okay, so putting it all together, why is this considered so flawed? You mentioned the 10% cap.
That 10% cap is a huge issue. There's simply no objective data or market study that supports capping inherent diminished value at 10% of NODA value. In fact, NADA itself explicitly says it does not recognize diminished value and has no data to support any specific value loss calculation for damage.
Wait, the source they use for the initial value says it doesn't recognize DV and has no data for it.
Correct. It fundamentally undermines the premise of using that 10% cap tied to native value. It's basically an invented number used by insurers.
That's pretty damning. What else is wrong with it?
Another major flaw is the one-size-fits-all fallacy. Applying the same 10% starting point to, say, a high-end luxury car versus an economy car makes no sense. Damage history impacts more expensive, rarer, or enthusiast vehicles much more significantly in the marketplace than it does a basic commuter car. The percentage loss is often far greater for those higher value vehicles.
Right, a dent in a Ferrari is a different story than a dent in a Civic.
Exactly. The formula doesn't account for that nuance. And speaking of nuance, there's also a lack of regional sensitivity. NAD values themselves don't always fully capture local market variations, even if they ask for a zip code. A convertible might be worth significantly more in Southern California than in, say, Alaska. But 17 Sin doesn't really account for those real-world market differences.
Okay, so the cap is arbitrary, it treats all cars the same, and ignores location. What else?
There's the double penalty for mileage. Think about it. NADA value already accounts for mileage. A higher mileage car has a lower NAD value to begin with. Then 17 Sin applies another separate mileage penalty multiplier, hitting you twice for the same factor.
I see. Yeah, that doesn't seem fair.
And capping the value loss entirely at 100,000 miles is also arbitrary. Plenty of vehicles over 100K miles still have significant market value and can suffer diminished value. Think about well-maintained trucks or popular SUVs.
True. And does the formula capture everything about the damage itself?
No, that's another big gap. It often misses key damage factors. Standard 17C calculations might not properly account for things like flood damage, fire damage, even significant frame damage sometimes isn't weighted enough. Or airbag deployment, a huge red flag for buyers, might not be factored in correctly. It also doesn't consider the impact of that negative vehicle history report itself on buyer perception.
So the bottom line here is, the 17C formula, while common, is likely to give you a much lower number than your car actually lost in value.
That is the overwhelming consensus among independent experts, yes. Real diminished value can only be accurately determined by looking at the actual market, comparing similar vehicles, considering the specific damage and repair quality, basically through a professional, market-based appraisal, not a simplistic, insurer-friendly formula.
Which leads us perfectly into the next crucial topic, the power of getting an independent appraisal. Why is this so important if you're serious about your DV claim?
It's arguably the single most important step you can take to get a fair settlement. There are several key reasons why an independent appraiser is so valuable.
Okay, lay them out for us.
First, you get a fair and impartial valuation. An independent appraiser works for you, not the insurance company. Their goal is to determine the actual loss in market value without any incentive to lowball it.
So unbiased expertise.
Exactly. Second, they have specialized knowledge. Many independent appraisers focus specifically on diminished value. They understand the nuances, how repair quality affects value, the impact of accident history stigma, local market trends, things a general appraiser or dealership might miss.
And they provide detailed proof.
Absolutely. That's the third point, detailed reports. A good independent DV appraisal is thorough. It documents the pre-accident value, the vehicle's condition, the repairs done. It includes market comparisons of similar vehicles sold with and without accident histories, photos, data. It's a robust piece of evidence that's hard for an insurer to simply dismiss.
That sounds much stronger than just saying, I think it's worth less.
Night and day. Fourth, related to that, is their market knowledge. They often have a much better handle on local market conditions, buyer preferences, even seasonal trends that affect used car values compared to generic online tools or national guides like NADA or KBB.
So all this adds up to potentially getting more money.
That's the fifth benefit, higher payout potential. Armed with a detailed, credible, independent report, you have much stronger leverage in negotiations. It justifies your demand and makes it harder for the insurer to stick to a low 17C-based offer. People often recover significantly more than the appraisal cost.
That makes sense. Does the appraiser help beyond just the report?
Often, yes. Six, many offer guidance and support. They can help you understand the process, advise on how to present your claim, how to respond to counteroffers. It can be incredibly helpful having an expert in your corner.
And if things get really difficult, if you have to escalate?
That's the final point, building a stronger legal case. If negotiations fail and you need to pursue mediation, arbitration, or even small claims court, that independent appraisal report serves as credible third-party expert evidence. It carries significant weight.
Okay, that's a compelling case for getting an independent appraisal. But what about the cost? You hear numbers like, what, a few $100s? Is it always worth it?
That's a fair question. Costs can range maybe $100 on the very low end for a simple report, up to $700 or maybe more for a very complex case or high-value vehicle. Typically, maybe $300 to $500 is common.
So if your potential diminished value is only, say, $500 on an older car,
Yeah.
maybe the math doesn't work out.
Possibly. For very small claims, you have to weigh the cost versus the potential recovery. Some might argue it's not worth it if the likely DV is only a few $100s more than the appraisal fee.
But for bigger claims,
For more significant damage or higher value vehicles where the DV could be thousands, the return on investment is often substantial. Paying $400 to get an extra $2,000, $3,000, or even more back from the insurer is clearly worth it. We've seen examples where people recovered thousands based on an appraisal when the initial offer was zero or just a few hundred.
and sometimes the insurance company might even have to cover the appraisal cost.
In some jurisdictions or specific circumstances, yes. If the appraisal significantly proves their initial offer was unreasonable, they might be required to reimburse your appraisal fee as part of the settlement. It depends on state regulations and the specifics.
And just to be crystal clear, relying on, say, a free appraisal from a car dealership or just printing out a Kelley Blue Book value, that's generally not going to cut it for an insurance claim.
Generally, no. Dealership appraisals are often focused on trade-in value, not fair market value or diminished value specifically. And KBB, NADA online tools, they're just guides. They don't provide the detailed, specific market analysis and documentation required to formally prove a diminished value loss to an insurance company. You need that dedicated DV appraisal.
Right. This has been incredibly illuminating. It really feels like diminished value is this whole area where you, the car owner, need to be really proactive and informed.
That's the core message, really. To quickly recap the big takeaways for everyone listening. First, diminished value is real. It's a genuine financial loss after an accident, even if your car looks brand new after repairs.
Second, don't just accept what the insurance company offers, especially if it seems low. Educate yourself, know your rights in your state, and be proactive in making your claim.
Third, be aware of that 17C formula. It's common, but it's widely seen as flawed and likely undervalues your actual loss. Don't take it as gospel.
And fourth, that independent appraisal. It's probably your single most powerful tool. It provides the proof you need to negotiate effectively and secure a fair settlement.
Absolutely. Be persistent in your negotiations. Don't be afraid to formally demand what your evidence shows you're owed. And if you hit a wall, consider getting help from consumer advocates, public adjusters specializing in DV, or even legal counsel.
So, thinking about everything we've uncovered today, especially the way diminished value is often calculated using formulas like 17C, and the need for you to fight for fair compensation, what does this really tell us about whose side the system might lean towards? And maybe more importantly, what steps will you, the listener, now take to make sure your financial interests are protected the next time you're dealing with the aftermath of an accident?